Guests, welcome to the 2025 William G. Demas Memorial Lecture. The William G. Demas Memorial Lecture series seeks to honor the thought leadership of the Caribbean Development Bank's second president by bringing into focus the issues and initiatives of significance to the economic development of the bank's member countries. Mr. Demas was a politician and banker from Trinidad and Tobago and the first Secretary General of the Caribbean Community, or CARICOM, from 1973 to 1974. He was also Secretary General of the Caribbean Free Trade Agreement, CARIFTA, from 1969 to 1973. I would like to take this opportunity to acknowledge the presence with us tonight of Mr. Demas's daughter, Alison Demas. Thank you. Thank you for being with us. Thank you. So it is my great honor to introduce our speaker for the 2025 edition of the William G. Demas Lecture, Dr. Nigel Clarke. Dr. Clarke is the Deputy Managing Director at the International Monetary Fund, or IMF, a role he assumed on October 31st, 2024. Before joining the IMF, Dr. Clarke served as Jamaica's Minister of Finance and the Public Service and a Member of Parliament since March 2018. Prior to this, he served as Ambassador of Economic Affairs from 2016. During this period, he stewarded his country's economy to a stronger and more sustainable position. He spearheaded ambitious national reforms, including central bank independence, the creation of an independent fiscal commission, as well as other tax policy, public body governance, public procurement, public sector compensation, and public investment management reforms. He also led Jamaica's economic policy response to the COVID-19 pandemic with innovative and well-targeted policy support, and completed privatization and public-private partnerships of major Under his stewardship, Jamaica implemented a multi-layered disaster risk financing model and became the first small country to independently sponsor a catastrophe bond with World Bank assistance. In 2023, Jamaica successfully completed its first ever international issue of a local currency denominated bond, and in 2024, Jamaica successfully executed its first ever securitization transaction in international capital markets. In 2022, Dr. Clarke was elected chairman of the Board of Governors of the Inter-American Development Bank and the Inter-American Investment Corporation. Prior to his public service career, he was vice chairman and chief financial officer of the Mousson Group, a regional conglomerate, having started his career as equity derivatives trader at Goldman Sachs in London. Dr. Clarke holds a PhD in numerical analysis from Oxford University, where he was a Rhodes Scholar, and a Master of Science degree in Applied Statistics, also from Oxford. While he was a Commonwealth Scholar, he also holds a Bachelor of Science degree in Mathematics and Computer Science from the University of the West Indies, where he was a Jamaica independence scholar. Ladies and gentlemen, delivering today's lecture entitled The Caribbean Challenge, Fostering Growth and Resilience Amidst Global Uncertainty, please join me in welcoming to the podium an exemplary leader, public servant, and visionary, Dr. Nigel Clarke.
President and Chairman of the Board of the CDB, Mr. Daniel Best, members of the Board of Directors of the CDB, and members of the senior staff of the CDB, Governor Antoine, stakeholders of the CDB, our Brazilian hosts, ladies and gentlemen, good evening. It is a delightful pleasure to be here with you on the 55th annual meeting of the Caribbean Development Bank. Thank you, Valerie, for that very kind introduction. And I also take the opportunity to thank the bank for giving me the honor of delivering this year's lecture in memory of Dr. William Demas. It's highly symbolic that this year's meeting takes place in Brazil for the very first time. This symbolizes a new beginning for the CDB and demonstrates the CDB's broad and international coalition of shareholders, all vested in the CDB's success. The CDB is an incredibly important institution that has a vital role to play in the region's development. It must be cherished, it must be supported, even as it delivers value to its borrowing and non-borrowing members in harmonious partnership with all of its stakeholders. This is also the first CDB annual general meeting under the presidency of Mr. Daniel Best. It is therefore in order to again congratulate President Best and to wish him tremendous success. Please. Dr. Demas's contribution throughout his career as a policymaker, as an academic, and as an economist cannot be overstated. He left a legacy of far-sighted vision and Caribbean excellence, a legacy that the whole region can be proud of. We need to channel that vision of excellence to meet two urgent priorities in the region. The first is to lift growth prospects and living standards, and the second is to build resilience against persistent economic shocks and natural disasters. These two objectives go hand in hand. We need the second to sustainably deliver on the first. At a moment of exceptional uncertainty in the global economy, these tasks become even harder, and our efforts become even more urgent. Today, I'll address the growth and resilience challenge both in the global context and in the context of the Caribbean region. I'll then discuss how regional policymakers can respond by implementing sound macroeconomic policies and by following through on necessary structural reforms. Finally, I'll share how the IMF is supporting our members to boost growth prospects and resilience in today's very uncertain global climate. Let me first start with the global growth outlook. After a series of shocks over the past 5 years, the global economy seemed to have stabilized at a steady but underwhelming rate of growth, at least as compared with recent experience. However, the landscape has now changed. Major policy shifts have signaled a resetting of the global trading system. In April, the effective tariff rate, the effective US tariff rate jumped to levels not seen in a century. And while trade talks continue, there's been a scaling back of some tariffs, but trade policy uncertainty remains off the charts. As a result, we significantly downgraded our most recent global projections in April in the World Economic Outlook published by the IMF. Downgraded by 0.5 percentage points for this year, from 3.3% to 2.8%, and by 0.3 percentage points in 2026, from 3.3% down to 3%. This represents the lowest global growth in approximately 2 decades, outside of 2020, the year of the pandemic. A natural question is, if trade tensions and uncertainty persist, what could be the impact on global growth? To start, we know that uncertainty imposes huge costs. With complex modern supply chains and changing bilateral tariff rates, planning becomes extraordinarily difficult. Businesses postpone investment and shipping decisions, and we know that the longer that uncertainty exists, the larger the costs imposed. In addition, rising trade barriers hit growth up front. Tariffs do raise fiscal revenues, but come at the expense of reducing and shifting economic activity. And evidence from past episodes suggests that higher tariff rates are not paid by trading partners alone. Those costs are passed on to importers and ultimately to consumers who pay higher prices. Protectionism also erodes productivity over the long run, especially in smaller economies. Shielding industries from competition reduces incentives for efficient resource allocation, and past productivity and competitive gains from trade are eroded, which ultimately hurts innovation. Tariffs will impact economic growth, but will do so differently across countries. But no nation is immune. The IMF's most significant downgrades to growth are concentrated in countries affected the most by recent trade measures. Low-income countries face the added challenge of falling aid flows as donor countries reprioritize resources to deal with domestic concerns. And we've already seen that in global financial markets there has been increased volatility. Equity market valuations declined sharply in response to the April tariff announcements, and unusual movements in US currency and bond markets followed. Now, equity markets have since regained some lost ground on hopes of a swift resolution to trade tensions. But with continued uncertainty and tighter financial conditions, we assessed in our most recent Global Financial Stability Report that risks to global financial stability have increased significantly. These global realities result in 3 main vulnerabilities. The first is that valuations remain high in key segments of global equity and corporate bond markets. If the economic outlook worsens, these assets are vulnerable to sharp adjustments. This could in turn affect emerging market currencies, asset prices, and capital flows. Second, in more volatile markets, some financial institutions could come under strain. especially highly leveraged non-bank financial institutions, with implications for the interconnectedness of the financial system. Third, sovereign bond markets are vulnerable to further turbulence, especially where government debt levels are already high and elevated. Over the last decade, global public debt has risen by an appreciable degree. And at the same time, financing costs have also increased dramatically, resulting in interest taking more fiscal space in national budgets across the world. And in emerging market economies, which already face the highest real financing costs in a decade, they may now need to refinance their debt and finance fiscal spending at even higher costs. These vulnerabilities and the potential for impact in emerging economies should not be underestimated nor ignored. But let me step back from these most recent economic and financial developments. As I mentioned, global growth prospects were already underwhelming, even before the April tariff announcements. And looking over the medium term, these global growth prospects, as I mentioned earlier, remain at their lowest level in decades. Now, what is driving this? Our analysis shows that a significant and broad-based slowdown globally in productivity growth accounts for more than a half of the decline in global growth. This is partly because global labor and capital have not been flowing to the most dynamic firms in all parts of the world. Lower private investment after the global financial crisis and slower working age population growth in some major economies have exacerbated the problem. Our studies show that without a course correction, global growth rates by the end of this decade would be below the pre-pandemic average by about 1 full percentage point. Simply put, new uncertainties on top of already weak economic prospects make for a very challenging growth backdrop. It is not surprising then that most Caribbean countries also face a challenging economic outlook. In our latest World Economic Outlook, published earlier this year, we already projected tepid growth in the Caribbean region overall, even before accounting for the US tariff and trade policy adjustments. Stronger performance in some countries, such as Jamaica and Trinidad and Tobago, was offset by slower growth in others. And in several countries, crime weighs heavily on growth prospects, particularly in Haiti, where the security situation hampers efforts to sustain economic activity, implement reforms, and attract aid and foreign direct investment. On top of that, we estimated that the April tariff announcement and its global spillovers would lower Caribbean growth further by at least 0.2 percentage points on average. But the impact varies across countries. In tourism-dependent economies, where growth is closely tied to US economic activity, the impact will mainly depend on the size of the US tourist base. In oil exporting countries, lower commodity prices and higher volatility are the main channels of transmission. Lower global growth means lower demand for these commodities, which adversely impacts the economies of commodity exporting countries. Slower growth while a relatively recent phenomenon from a global perspective, is unfortunately not new to the Caribbean region. Declining growth trends in the Caribbean region have loomed over the longer horizon as well. Recent IMF analysis shows that most Caribbean countries had significantly slower growth over the last 2 decades, that is 2001 to 2023, as compared with the previous 2 decades, 1980 to 2000. And on this slide, we have many of the countries of the Caribbean region, and what you see is that for most countries, apart from 3, growth over the last 20 years has fallen quite a bit short of growth over the previous 20 years. It's a common story of a declining growth rate across the Caribbean region. And this ought to be cause for some concern, because it presents the Caribbean with an aggravated challenge. And that challenge is to reverse the trend of slower growth at a time when global growth itself is also declining. Going up the down escalator. That is, the challenge is to reverse the trend of slower growth when the wind in the proverbial sail is weaker and has even changed direction. Let us be clear about what is at stake. Slower growth in the Caribbean slows the improvement in living standards and stymies the aspirations of Caribbean people for better opportunities. Slower growth in the past has also meant that convergence in income levels between the Caribbean and advanced economies has stalled. In other words, the gap between the fortunes of the Caribbean national and that of her counterpart in the advanced world is growing wider. Of course, there are exceptions to this regional trend. In particular, Guyana's economy has grown rapidly over the past 2 decades, progressing from low middle income to high income status. Growth accelerated to 45% on average in the past 3 years, making Guyana the absolutely fastest growing economy in the world. You can't hold the Caribbean down, eh? We must have the fastest. But for the Caribbean more broadly, the questions on which we should focus is what exactly explains the pattern of declining growth? And what is the appropriate menu of policy responses to arrest and reverse this pattern? With respect to the first question, as in the rest of the world, a key explanation for declining growth is weak productivity growth. I want to focus on this chart for a second. This encapsulates both the problem and provides a guide to the solution. Here we show the Caribbean's growth potential on average between 1981 and 2000. And the Caribbean's growth potential was just over 3%. It doesn't mean that you achieve your potential, but that is the potential growth of the Caribbean region. And between 2001 and 2019, the Caribbean growth potential on average almost halved to just over 1%, 1.2 thereabouts. And we can decompose potential growth into its constituent parts. Now, physical capital, total factor productivity, and human capital. And we can see that all elements that contribute to potential growth, all of these factors have declined. but the productivity factor has declined the most in proportional terms. And the productivity factor is almost zero. It's a little elevated there just to make the yellow show. But productivity growth in the Caribbean has slowed to almost zero. So the growth challenge in itself is not a mystery. Growth potential, as I mentioned, can be decomposed into its constituent factors, and we can compare how the Caribbean's growth potential has declined over time. And such an analytical and data-driven approach reveals, as I mentioned, that the Caribbean's potential is about half of what it was before. And we zoomed into productivity growth, which is at the root of the problem. But also, growth in physical capital has slowed, and growth in physical capital accumulation, and growth in human capital has also slowed, leading, when you combine all three, to much lower growth potential than we had in the past. Now, ladies and gentlemen, there is no magic solution to the Caribbean's growth problem. There is no quick fix either. In fact, great danger lies if we believe that the growth challenge can be addressed with quick fixes. Solving the growth question will require as much effort that was put into the macro stability reforms successfully undertaken in Jamaica, Barbados, and Suriname. So the goal for policymakers is clear: to foster resilient and inclusive growth that sustainably raises living standards. And this can be achieved by, one, very importantly, maintaining and entrenching macroeconomic stability, and that has to be repeated on every occasion, because that is where the Caribbean historically has had repeated issues. And the second is to decisively and comprehensively address the factors that can raise growth potential. So I want to spend a little time on the first. As a prerequisite, countries should strive to pursue policies that restore, maintain, and entrench macroeconomic stability. Stable prices, sustainable fiscal trajectories, adequate foreign exchange reserves, and financial sector stability. The collective Caribbean experience powerfully demonstrates the transformative potential of macroeconomic stability. Jamaica, for example, was burdened with, and I'll just choose one variable, unemployment rates that averaged in the 20% region for all the periods from the early 1970s to the end of the 1980s, and averaged 15% from the 1990s going all the way up to the mid-2000s. And Jamaica was only able to achieve the previously unimaginable result of low single-digit unemployment, and we're talking about unemployment in the region of 4% or lower. Jamaica only achieved this when stability was restored and became entrenched. Stability is also a friend to the poor, as Jamaica's experience also highlights. Jamaica achieved the lowest poverty rate in its 61 years of independence in 2023. Again, on the back of entrenched macroeconomic stability, in the context of an institutionalized social protection framework supplemented by temporary and targeted counter-cyclical measures at times of distress. Friends, Our history and global economic history clearly demonstrate that economic stability is indispensable to national success, regardless of chosen social and political organization. Economic stability should therefore be guarded and protected as a national asset, allowing for focus on higher order challenges like structural reforms to unlock growth potential. For much of our the Caribbean's history as independent nations, it has been bedeviled by macroeconomic challenges. The time has come to recognize that stability once attained must never be lost, but instead be used to attack and solve higher order problems. Also, the requirements of stability should act as a constraint on policy. Any proposed action, policy action, that has the prospect of jeopardizing any of the components of stability should not make it through the policy formation gauntlet. Securing economic stability, therefore, into the future requires laws, but laws are insufficient. Stability over the long term is best preserved by developing, empowering, and strengthening institutions. Now, the Caribbean region hosts different currency regimes, but the key requirement is internal consistency within the chosen currency regime. Floating exchange rates, fixed currency regimes, each impose their own constraints, and these need to be observed for success. Now, while there's always room to improve in monetary policy frameworks, the areas within the macro stability complex that require urgent attention in the Caribbean are rebuilding fiscal buffers, strengthening fiscal frameworks, and bolstering resilience. Because let's face it, on top of all of the region's challenges, government budgets in much of the region are strapped. Providing extraordinary support in response to extraordinary shocks has depleted buffers. Public debt ratios have come down since the pandemic. This is good news. However, in many countries, and many Caribbean countries, debt and financing needs are still too high. In fact, for some Eastern Caribbean Currency Union, ECCU members, achieving their regional debt target of 60% of GDP by 2035, a full decade from now, will require sizable effort. Now, while timely fiscal consolidation, or with timely fiscal consolidation, countries can bring debt down, and by so doing, they can protect themselves against future shocks by creating space with which they can finance counter-cyclical responses. And they can, in the meantime, use some of that space to invest in crucial human and physical capital, which is an investment in their own future. In addition, some Caribbean countries have pegged exchange rates, which have been a long-standing anchor of stability. For example, in the Eastern Caribbean, broadly defined. The ECCU is one of only 4 currency unions in the entire world. The 4 ECCU, the CEMAC, which is the Community of Central African States, WEMU, the West African Economic and Monetary Union, and of course, the European Economic and Monetary Union. Only 4 in the world. And this is a testimony to the capacity of the Caribbean people to collaborate, to cooperate, and to innovate. However, to safeguard the stability provided by this currency union long into the future, fiscal policies within the union must be sustainable, need to be resilient, and consistent with the exchange rate regime. Inconsistency only serves to compromise the currency union with potential for destabilizing consequences. Our advice to policymakers on how to rebuild buffers and strengthen frameworks is straightforward. Mobilize tax revenues, spend wisely, and plan ahead. Mobilize tax revenues, spend wisely, and plan ahead. Let's start with mobilizing tax revenues. The tax revenue yield in Eastern Caribbean countries is falling short of Caribbean peers. Inefficient tax exemptions and weak tax administrations are leading to large losses. Broadening the tax base and removing distortions will not only increase revenues, but will also be able to support investment and growth. The fund has been providing technical assistance to our members in the Caribbean to support ongoing efforts in this area. Now let me turn to spending wisely. Not all spending is productive spending. Let me say that again. Not all spending is productive spending. With limited fiscal space, focus must be on spending that has the potential to deliver quantifiable social and economic returns within a reasonable time frame. Policymakers should keep the quality and composition of spending under review, including by containing unproductive spending, enhancing efficiency, and digitalizing government services. As for planning ahead, with conviction, credibility is critical to allow fiscal consolidation to proceed gradually with lower financing costs and better growth results. So you want to consolidate fiscally over that time period? Credibility is important, which means sending the right policy signals, not deviating from them, and living up to the commitments that are made. Strong medium-term fiscal frameworks with well-designed fiscal rules and specific plans for fiscal policies and reforms can help to bring debt down and investment up. Frameworks that combine debt and operational targets and are backed by adequate capacity and institutions can be particularly powerful. This approach worked well in Jamaica, where fiscal responsibility was written into the law under the Fiscal Administration and Audit Act and strengthened over time. The Act established a public debt goal of 60% of GDP and a rule that determines the annual targeted fiscal balance consistent with that objective. An independent fiscal commission is the arbiter of Jamaica's fiscal rules and provides an opinion on fiscal policy sustainability, strengthening credibility and accountability. Planning ahead also means being ready for the certainty of economic shocks. A golden rule in policymaking in a country is to design policies that fits that country's circumstances. Now, shocks are a permanent feature of Caribbean small state reality. So Caribbean policy ought, therefore, to make provisions for the inevitability of economic shock. In Jamaica's Act, there are clear escape clauses for large shocks and an automatic adjustment mechanism to secure a return to the debt target thereafter. Well-designed and transparent sovereign wealth funds can also help to stabilize public finances when shocks hit. For example, Trinidad and Tobago's sovereign wealth fund insulates fiscal policy from oil price fluctuation. Guyana's fund helps manage its natural resource revenues, finance investment, and save for the future. And St. Kitts and Nevis is considering a fund to smooth volatile revenues from the Citizenship by Investment program. Planning for shocks is ever more important in regions like the Caribbean that face the recurrent threats of natural disaster. Our countries need to be prepared before a disaster hits. Recurring natural disasters impair productive infrastructure. Remember that chart that shows the physical capital challenge that the Caribbean faces. Natural disasters are a part of that story. Natural disasters also hinder human development. On that chart I showed you, which I'll return to, you saw the challenge of human capital formation and how that affects the region's growth potential. Now, major disasters cost an average of 2% of GDP per year in Caribbean countries and close to 4% of GDP in Eastern Caribbean states. There is obviously a physical dimension to disaster preparedness, which involves investing in resilient infrastructure. There's also a financial dimension, which involves developing resilient risk transfer, contingent claim, and insurance mechanisms. Unfortunately, rising global private reinsurance premiums are making the task even harder. Domestic insurance premiums have also been rising. The result is lower insurance coverage in the private sector and thus potentially more burden on governments when a natural disaster strikes. Caribbean countries can secure a comprehensive insurance framework with multiple layers: self-insurance through their own fiscal buffers, participation in pooled risk transfer instruments, contingent financing, and potentially even catastrophe bonds. With respect to the first layer, Jamaica legislated a requirement to save annually for a natural disaster fund. I recognize, however, that some countries in the region, individual buffers have declined since the pandemic and need to be restored. On the second layer, the Caribbean Catastrophe Risk Insurance Facility helps fill an important gap. Coverage has steadily improved since its inception, and the CRIF, as it's commonly known, has made prompt payouts after various natural disasters. This includes over 85 million US dollars across Grenada, St. Vincent and the Grenadines, Trinidad and Tobago, the Cayman Islands, and I know this personally, Jamaica, in a matter of days after Hurricane Beryl, underscoring the facility's critical importance to the region. Further expanding coverage would pay off in the long term. On the third layer of contingent financing, the World Bank has approved catastrophe deferred drawdown options, CDOs in the lingo, for Barbados, for Dominica, for Grenada, for Jamaica, for St. Lucia, for St. Vincent and the Grenadines, and with other countries in the pipeline. Furthermore, Grenada and St. Vincent have already drawn on these CAT DDOs, following natural disasters. In addition, the IDB has credit contingent facilities with Antigua and Barbuda, the Bahamas, Barbados, Jamaica, St. Vincent, and the Grenadines, among other countries. On the fourth layer, Jamaica has, with World Bank assistance, independently sponsored 2 catastrophe bonds. So the region is moving in the right direction in terms of planning for disasters, and this needs to be supported, strengthened, and further improved. Now, to be clear, to be absolutely clear, stability and resilience and risk transfer by themselves do not automatically deliver the elevated growth needed. However, elevated levels of economic growth in our small states cannot be sustainably achieved without stability, resilience, and risk transfer. Furthermore, stability and resilience set the stage for elongating the economic cycle by significantly lowering a country's risk premium, lowering the cost of capital, expanding the frontier of project feasibility and viability, and providing the counter-cyclical capacity to respond to shocks, thereby limiting the duration and intensity of downturns and providing for longer, unbroken periods of consecutive economic growth. The Jamaican experience again demonstrates these relationships. To achieve higher growth, in addition to stability, policymakers have to decisively address factors that elevate growth potential, beginning with the productivity gap. So addressing the growth challenge requires reversing the decline in the Caribbean's growth potential by improving total factor productivity and boosting investment in human and physical capital. Our analysis for the ECCU shows that the bulk of total factor productivity losses come from the high cost of finance, from cumbersome tax administration, from inefficient business licensing and permits, and from skills mismatches in the workforce. From my experience, and these are measured and can be measured and have been measured. From my experience, this can be applied to most of the Caribbean beyond the ECCU. Now, overcoming these obstacles could bring substantial productivity gains. If these obstacles here on the screen, skills mismatches, business licensing and permits and regulation, tax administration, cost of finance, were appropriately addressed, productivity gains could range from 34 to 65%, which would be an incredible result. And it would close the gap in income per capita with the United States as a baseline by between 9 and 27 percentage points. Now, one practical step in achieving some of this agenda is to promote digitalization of Caribbean societies, which can significantly boost productivity. Now, this will require a multifaceted strategy, including investing in digital infrastructure, digital transformation of government, reducing the cost and increasing the availability of data transmission, improving digital literacy, and other factors. Application of digital tools and technologies to improve access to government services while reducing time ought to be seen as a non-negotiable imperative. As an obvious example, further enhancing taxpayer access to digital government services through e-payment, e-filing, and e-registration would not only reduce the administrative burden on businesses, but encourage compliance, fostering a better environment for entrepreneurship. In much of the Caribbean region, businesses have to navigate a complex labyrinth of licensing and permitting and regulatory regimes. Anybody who has been in business in the Caribbean region can give you copious examples as to this unnecessary complexity. This is a big drag on productivity. While the largest enterprises in the region have the scale to absorb the inefficiencies, smaller firms suffocate from overly burdensome processes. And we know that economic vitality depends on the vitality of small and medium-sized firms. There is therefore tremendous scope in the region to greatly simplify regulatory processes and eliminate unnecessary steps. Furthermore, with the digitalization of licensing and permitting and regulatory procedures, it promises to enhance the efficiency of firms, boosting productivity. Instead of having to go all the way to Port of Spain to apply for the permit to import, or the permit to, or the license for a particular activity, if you can stay in your business miles away and go online and make your application and get it approved, the productivity of that business multiplies. The same is true in Jamaica. If you can stay in Westmoreland and not have to travel into Kingston and spend hours going from ministry to ministry to get your license and your permits, that firm's productivity increases dramatically. This leads me to another practical step, improving access to finance, which can encourage new businesses and support a transition to the more formal sector. Finance is the oxygen of business, as I like to say, and its affordable and widespread availability is essential for having a dynamic business environment. There could be an entire session on improving access to finance, as it is so fundamental, yet so complex and so multifaceted. Many factors hinder access to finance in the Caribbean, and I'll only touch on a few. First, legacy weaknesses in banks' balance sheets limit access to credit, investment, and growth in the region. So it is important to address bank vulnerabilities across the region. This includes timely compliance with regulatory standards and easier ways to dispose of impaired assets. Progress is happening. Banks are building buffers and reducing non-performing loan ratios. But more work is needed to ensure that all banks meet regulatory minimums. Reducing the costs of non-performing loan resolutions ultimately reduces the cost of loans. This can be achieved through modernizing insolvency regimes to encourage faster out-of-court debt workouts and the emergence of asset management companies that are, if they're properly funded, that can facilitate asset disposals. Collateral infrastructure should also be strengthened through effective credit registries and partial credit guarantee schemes. For example, the recent created Regional Credit Bureau in the Eastern Caribbean can help lower the cost and time of credit risk assessments and close negative asymmetry gaps. This will help small and medium-sized businesses access credit and safeguard credit quality. Stronger anti-money laundering and anti-terrorism financing frameworks can help protect the financial system from external threats and retain corresponding banking relationships, the absence of which impedes access to credit. The above financial sector measures are absolutely necessary but hardly revolutionary. Revolutionizing access to credit in the region could be achieved by enabling mobile, real-time, instant, 24/7 payment system platforms, as exists in India through their Unified Payment Interface, UPI, and right here in Brazil through the world-famous PIX. In both India and Brazil, access to finance and to financial services have been transformed by these payment platforms, and inclusiveness expanded by these innovations. Transactions are free, for the most part, or ultra-low cost, and these payment platforms are integrated into banking apps and into e-commerce platforms. Of course, these systems only exist within the context of a national identification system that provides a means for the necessary identity verifications as required. So I'm not presenting this as an easy solution because there are prerequisites, but it is worthy of serious consideration to improve access to finance. Now, the use of oil imports for electricity generation throughout the region is obviously costly. One of the few regions in the world that uses as much oil for electricity as we do in the Caribbean region. And the high cost of electricity fundamentally undermines competition, particularly for the tourism industry, at the expense of potential growth. Electricity is one of the major component costs in the tourism sector. As we explored last December in the Caribbean Forum that was held in Barbados, a successful energy transition can foster inclusive, sustainable, and resilient growth. The transition will look different for energy importing countries than it looks for energy exporting countries. And the region, a diverse region, is composed of both categories of countries. For energy importers, diversifying into renewable energies with fast declining costs can reduce reliance on expensive and volatile oil and hydrocarbon imports. It would also offer relief from some of the highest electricity costs in the world. Consider this key fact: electricity in many Caribbean countries costs a minimum of twice as much as in advanced economies. We have been discussing this in the region for a long time, too long. The energy transition would enhance external sustainability for energy importers while making them more competitive, more resilient to shocks, and more likely to grow faster on a sustainable basis. And here we just show how renewable energy costs have plummeted over the past decade or more. Solar, wind, and other forms of renewable energy costs. But seizing these opportunities is not trivial. It requires tackling key obstacles. For example, high upfront investment costs. And of course, those costs are lower the stronger your macroeconomic environment. And that's why stability is so critical, because it makes major projects more viable. opportunities, bringing more women into the labor market can contribute to economic growth. We estimate that, for example, eliminating the gender gap in the ECCU, for example, and it's nice to kind of study the ECU, and you know, so I'm generalizing a lot of the studies that we have of the ECCU, but eliminating the gender gap in the ECCU, which is over 11 percentage points on average today, that could boost ECCU regional GDP by roughly 10 percentage points. That is a powerful economic case for inclusive labor policies, such as enhanced access to childcare and elderly care. Too many females are outside of the labor market because they are in childcare and providing elderly care. And if some of that is borne socially, it can release more persons to be available in the labor market, boosting the output of countries. And this is generalizable across the Caribbean region. It is also imperative to foster opportunities for youth. Caribbean countries have some of the highest youth unemployment rates in the world, ranging from 10 to 40%. Empowering future generations is at the core of addressing growth and resilience challenges in the region. Now, it's important, and I want to acknowledge important efforts led by the Caribbean Community, CARICOM, to work towards deeper social and economic integration. Earlier this year, we saw tangible progress. The CARICOM members are working to enable free movement of nationals, and this initiative also includes access to primary and secondary education and emergency health care and primary health care. Now, improved infrastructure enhances the productivity of capital as well as the productivity of labor. The Caribbean will need much higher levels of investment to restore and boost its growth potential. Workers depend on public transportation to get from home to work and back again. If this, for example, routinely takes an hour and a half each way, on average, across a population, and costs a third of weekly wages, then labor productivity will suffer. Efficient, affordable, accessible mass transportation enhances productivity. Now, while taxis complement bus transportation, they cannot be an effective substitute. This is more of a problem in larger Caribbean countries, and I know Jamaica is tackling this problem head on. Similarly, road and highway connectivity opens new investment opportunities and reduces the cost of transportation of people and goods and enhances the productivity of capital and labor. More modern commerce, and obviously by doing so, elevates growth potential. Modern commerce relies on communication and, importantly, data. I referred to this earlier. There's scope for investing in broadband infrastructure, lowering the cost of data and making data access more available. This will require investment, private investment, hopefully, but it needs to be facilitated by government policy. Water is a source of life. Without water, communities are less productive and businesses cannot function. Across the region, significant investment in water treatment, water storage, water distribution, infrastructure will be required to support economic growth and improve standards of living across the medium term. All of these elements of infrastructure, transportation, broadband, roads, water, energy, and more, need considerable investment to keep Caribbean societies competitive and to raise the growth potential. However, Caribbean governments will not have the required resources to finance these investments from tax revenues and at the same time fund education, health, security, and other essential services. As such, governments will need to focus on attracting local, regional, and international private capital in well-structured transactions to finance productivity-enhancing infrastructure needs of the region. This can be accomplished through the variety of public-private partnership modalities that exist and with the advice of multilateral partners such as the IFC and the IADB, who are very experienced in structuring these kinds of transactions and who know what is required to generate investor interest. I speak from experience. The IFC has been instrumental in assisting Jamaica in its pipeline of PPPs. But my advice, however, is not to develop PPPs sequentially, one at a time, starting one as the other one it concludes. Given the preparation period, sequential development of PPPs will take too long. Instead, pursue PPPs using a programmatic approach. That is, develop a pipeline of infrastructure PPPs in parallel so you can bring these to market in rapid succession. The time and resources required for investors to familiarize themselves with the macro environment, the legislative framework, the regulatory architecture, the country risks, with uncertainty around bid success, that cost needs to be amortized over a number of transactions in order to attract deep-pocketed investors and experienced investors to provide competitive bids. Open, transparent, and well-structured PPPs can help bridge the infrastructure gap and boost productivity. These are not easy times, and these are not easy steps to take. Vision, coordination, partnerships, technical expertise, and lots of energy. But these steps can put Caribbean countries on a path towards greater growth and resilience. Rest assured that the IMF remains fully committed to supporting our members across the region. Our near universal membership provides us with a unique global perspective, and we are informed by a large range of cross-country experiences over the last 80 years. With 191 member countries, the IMF, as compared with the United Nations with 192 members, just one more, is as global as it gets. We engage with each of our countries' members on a country-by-country basis, as well as on a regional basis with currency unions like the ECCU. Our member states, including Caribbean states, are shareholders and owners of the IMF. We work for you, and we do so through three modalities. Surveillance, where we provide a review, a comprehensive review of our member countries' economy and on an annual or biennial basis. This review, called Article 4 review, as we all know, is a principal obligation of IMF membership, and it contains country-specific advice which is published and freely available online. I encourage media practitioners, economists, financial analysts, public policy advocates, and citizens interested in their country's development to make use of these Article 4 reports. Download them, discuss them, circulate them. The second modality through which the IMF provides service to its members is capacity development, where we provide technical assistance and tailor-made policy advice on specific issues that countries may be grappling with. Designing of tax policy measures, improving efficiency in public spending, optimizing public debt management, bolstering the capacity of statistical agencies, etc. And development of monetary policy tools are some examples. Under this modality, we have training courses for public officials through regional institutions such as CARTAC. Our third modality is the one countries are most familiar with. The IMF provides financing to alleviate and address balance of payments challenges. Our long-established lending toolkit helps countries restore macro stability, and in the restoring of macro stability, we have had successful engagements across the region. Jamaica, Barbados, and Suriname come immediately to mind. At a recent IMF spring meeting, I moderated a panel where the Greek finance minister made the point that at this juncture of very challenging fiscal circumstances in the Eurozone, only 6 countries of the 27 member EU countries have fiscal surpluses. And it so happens that 4 of the 6 had IMF programs during the global financial crisis. And the IMF continues to evolve to meet the needs of our members. Our rapid facilities provide emergency financing when shocks hit. And our newer resilience and sustainability facility provides affordable long-term financing to support resilience efforts. And on the slide, we just have many of the examples of countries across the region accessing IMF facilities over the last few years. Jamaica has accessed the Funds Precaution Liquidity Line, which provides an insurance, and Jamaica didn't need to draw on it. Barbados and Jamaica benefit from the Resilience and Sustainability Facility. And we have a staff-monitored program with Haiti, a program designed to support Haiti's economic policy objectives and to build a track record of reform, which could pave the way for financial engagement with the IMF. And of course, the effectiveness of our advice and financial support is enhanced by our continued efforts in capacity development, and CARTAC in the region plays a critical role in providing advice. And here we just have some of CARTAC's services across the region. Now, in my time at the fund so far, I've seen how much advanced economies, advanced countries rely on and use the IMF's intellectual output to the benefit of their countries, and how this output features in and informs public discourse in many member countries. The IMF is an incredibly powerful resource that belongs to you, that works for you. And I strongly encourage Caribbean countries to strategically maximize their use of the IMF and of what it has to offer. Let me conclude. Policymakers in the Caribbean are facing a complex set of old and new challenges. But challenging times can also be times of opportunity, of action, and resolve. The Caribbean is a region of immense promise, with rich cultural heritage, natural beauty, and vibrant populations. The world is undergoing profound change. This change introduces global vulnerabilities to which the Caribbean is not immune. The resilience of small open economies like those to be tested.
What an inspiring lecture you gave us tonight. Thank you so much. We have time for one question before we proceed with the vote of thanks. But I think that given the current situation with the Caribbean Development Bank hosting its annual meeting here in Brazil, and you did mention at the beginning of your lecture that it is indeed symbolic that this annual meeting is taking place in Brazil, notwithstanding the fact that Brazil's economy is much larger than those of Caribbean countries. In your opinion, are there any lessons that the Caribbean can learn from Brazil's experiences?
Thank you, Valerie. Well, first of all, it's fantastic that the meeting is being held here in Brazil this year. Brazil obviously is a much larger economy than the economies of the Caribbean region, but something that struck me, I've been here sort of meeting with Brazilians from all walks of life, and something that struck me is that, Brazil's experience has been one where global economic disruptions have historically translated into the Brazilian economy in an amplified way. Financial market practitioners would describe it as Brazil having been a high beta country, that it amplifies economic shocks. So you know what the Brazilians have done as a response? Brazil, in their federal treasury management, they retain up to 10% of GDP in cash. You heard what I said? Their treasury at any point in time has up to 10% of GDP in cash as a buffer, because having experienced the historical disturbances economically that has been a feature of their history, they said, no, we are going to design our policies to take control of our circumstances. So we can't find ourselves in a position where there's some disruption overseas. It's amplified in Brazil. We cannot go to the market for financing. So how we're going to deal with it is that we're going to self-insure with this large fiscal buffer. Now, for all Caribbean countries here, Jamaica and Trinidad, Barbados and Lucia, Guyana, Antigua, Dominica, Grenada, St. Vincent, etc. If Brazil Big, big Brazil with 200 million people, the 8th largest economy in the world, can take such steps to support its macroeconomic stability and resilience. What more? What should we be doing? Or what should the Caribbean be doing? I'm not recommended by any means that Caribbean countries should retain cash levels of that. That is Brazil's particular policy response. But what I'm saying is that resilience and stability are essential foundations, layers without which not much more can be achieved. So that to me is one of the principal lessons sort of from Brazil. The second is, I mentioned in my presentation, which is their response to financial inclusion. Brazil has innovated the PIX, which allows anybody, vendors on the street, the proverbial man on the road, to transact at any hour of the day, instantly, 24/7, real-time settlement by your mobile phone. And that is an innovation that should inspire the Caribbean.
Thank you. Thank you so much. In order to keep with time, yes, thank you. We have one last formal segment of this William G. Demas Memorial Lecture, and I would like to invite to the stage Mr. Ian Durant, Acting Vice President of Finance and Corporate Services at the Caribbean Development Bank, to deliver the vote of thanks. Mr. Durant, if you please.
Good evening, all. I have to say that when I reached out to Dr. Clarke in February this year to invite him to be this year's William G. Demas Lecturer, this is exactly the quality of insights that I was expecting. And Dr. Clarke delivered. So, ladies and gentlemen, as we draw this inspiring evening to a close, let us take a moment to reflect on the invaluable ideas and insights shared. Tonight, we had the privilege of hearing from a distinguished leader, thinker, trailblazer, and son of the Caribbean soil, Dr. Nigel Clarke. Through his thought-provoking lecture, we explored pathways to strengthening growth and resilience in the Caribbean, building on the enduring legacy of William G. Demas and this lecture series, which for over 2 decades has been a beacon of intellectual brilliance and transformative dialogue for the region. Dr. Clarke laid out the global context clearly for us, identifying the main trends that are likely to weigh on the performance of countries like ours. He reminded us that the context will constitute significant headwinds for us, but emphasized that even before these headwinds emerged, growth was declining consistently over the last 4 decades, largely reflecting receding factor productivity, or, what is the same thing, competitiveness, together with the impact of natural hazard events. The upshot of this is divergence between the standards of living in developed countries and those in the developed world, or rather, our developing countries and those in the developed world. Incidentally, this divergence also obtains between regional small island states and other SIDS. However, Dr. Clarke didn't stop at laying out the challenges. He provided us with a menu of policy imperatives that would help to increase productivity. Ultimately, this would allow our countries to enjoy sustained growth by enabling them to compete globally in a wider range of products. The resultant diverse sources of foreign exchange earnings would help to avoid the production starts and stops to which Dr. Clarke alluded. Dr. Clarke's reflections reminded us why we must remain unwavering in our commitment to advancing development across the Caribbean. He reminded us that our efforts are ultimately about the people of the Caribbean, their standards of living, and their aspirations. He implored us to focus singularly on these solutions that require us to collaborate, share knowledge, and embrace innovative leadership, qualities exemplified by William G. Demas himself. On behalf of the Caribbean Development Bank, I extend my heartfelt gratitude to Dr. Clarke for his extraordinary contribution tonight. His insights have challenged us and inspired us, providing much needed clarity and focus as we navigate global uncertainty in pursuit of a stronger, more resilient Caribbean. Thank you to everyone in attendance for your engagement and dedication to this important dialogue. Let us carry forward the wisdom we've gained and continue to work together to create a prosperous future for our region. Good night, and let's keep the conversation alive. Thank you.
Ladies and gentlemen, this concludes the William G. Demas Lecture for 2025. Thank you and have a very good evening. For those of you here with us on site, we have the cocktail reception outside, the traditional William G. Demas cocktail reception. Thank you very much. Thank you, Dr. Clarke.
Ha ha ha!